Welcome, deep divers. Today, we're set to really get into some fascinating financial insights. We're taking a deep dive into Procter & Gamble's Q4 earnings report, the one for the quarter ending June 2025. Now, if you just glanced at the headlines, you probably saw P&G reported, well, pretty solid revenue, $20.89 billion. That's up 1.7% year over year. And their EPS, the earnings per share, that climbed too. Hit $1.48, up from $1.40 last year. And interestingly, that revenue figure, it actually edged out the Zacks consensus estimate, just slightly, but still.
Yeah, the estimate was $20.81 billion, so it beat by, what, 0.39%?
Exactly. And the EPS, that $1.48, that was a nice positive surprise too, about 3.5% over the $1.43 estimate.
And, those headline numbers, they definitely catch your eye. But what's really crucial here, I think, is how often the real story for a company like P&G, especially if you're investing, lies, well, underneath all that. Those first figures are just kind of the surface. It's the key metrics, the finer details that really give you a much better look into the company's actual underlying performance. And they're what really shape how analysts, project the stock price going forward. So our mission today, let's move past those headlines, even the positive ones, and figure out what the details really tell us about P&G's health right now.
Okay, let's unpack that. A good place to start, I think, is organic sales growth. Many see this as sort of the purest measure of core health, right? It strips out acquisitions, currency effects.
Exactly. It shows growth from the existing business.
So for total P&G, organic sales growth came in at 2% year over year. Now, wasn't that actually higher than analysts were predicting?
That's a very sharp observation. Yes, it was. That 2% overall growth beat the four-analyst average estimate, which was 1.4%.
Good.
And you have to remember, for a huge established company like P&G, beating on organic growth like that, it's significant. It's not just a positive signal. It suggests their core strategies, maybe brand investments or innovations, are genuinely working, driving demand from within.
That makes sense. It's like the engine itself is running strong.
Precisely. It's often seen as healthier than just buying growth or benefiting from currency tailwinds.
Okay, but then when you start to drill down into the specific segments, the picture gets, well, a bit more mixed. It makes you pause a little.
Sure.
For example, baby, feminine family care, that grew 1% organically. That actually beat its estimate of 0.6%. So, okay, that's solid.
Right.
But then other segments didn't quite hit the mark analyst-wise. Beauty was 1% organic growth versus 1.7% expected. Grooming was 1% versus a much higher 2.8% estimate. That's a big miss.
Yeah, that one stands out.
Fabric and home care, 1% versus 1.4% estimated. And healthcare grew 2%, but the estimate was higher at 3.1%. So what's your immediate take on that? Why such a difference between the segments, especially when the overall number was strong? That grooming miss, for example.
Well, that's exactly why we do these deep dives, right? This kind of nuanced performance is key. You see the strong overall organic growth, but then these segment variations tell you P&G has different strengths and maybe challenges in different areas. For grooming's miss, you'd have to wonder, is it a bigger market trend, like maybe changing shaving habits or more competition from those direct-to-consumer brands?
Good point.
Or for fabric and home or healthcare, which also missed, were there maybe specific supply issues? Or did competitors get more aggressive on pricing that quarter? It just highlights that even a giant like P&G isn't a monolith. Each division faces its own unique market pressures.
Okay, so that covers the organic side, the core product performance. Let's shift now to how that actually showed up on the top line. The net sales figures for the quarter, did that fundamental strength, or maybe weakness in some areas, translate directly into the reported revenue?
Let's see.
Well, looking here, we do see some positives again. Fabric and home care reported $7.39 billion in net sales. That was slightly above the $7.36 billion estimate. Represents a 1.7% year-over-year change. Pretty steady.
Okay.
And baby, feminine, family care hit $5.09 billion, also beating its estimate of $5.02 billion. And again, up 1.7% year over year.
Right. So those positive net sales numbers in fabric and home and baby, fem, and family, that's encouraging. It suggests they're actually turning that consumer interest, that organic growth, into real dollars effectively. Maybe good pricing power, maybe volume, maybe a mix.
Yeah, it shows execution.
Exactly.
Yeah.
Especially in those core staple categories where consistency really matters. They're monetizing the underlying demand.
Now, here's something that really jumped out at me from the report. Honestly, made me do a double take. The corporate segment. It reported net sales of $274 million.
Okay.
The average estimate was only $186.14 million. That's a massive beat. And it marks, get this, a 35.6% change year over year, What on earth could drive such a huge jump in the corporate segment? That's not usually where the action is.
You are absolutely right to flag that. A percentage change that big in corporate, it's definitely unusual. That segment typically handles things, outside the main product lines, intersegment stuff, maybe some one-off gains or losses, corporate ventures. A surge like that often points to something non-recurring, something not tied to selling more Tide or Pampers.
Like what, potentially?
Well, it could be a significant asset sale, maybe, or perhaps they reclassified some revenue stream that used to sit elsewhere. Maybe a large IP licensing deal came through. It's the kind of number that makes an analyst immediately flip to the footnotes in the full report, the 10K, to find the explanation. It demands a closer look.
Definitely something to keep an eye on.
Meanwhile, looking at the other segments for net sales, grooming actually hit its estimate exactly, $1.68 billion, up 1.6% year over year.
Interesting. So net sales hit the target, but organic sales missed significantly.
Right. Which suggests maybe pricing increases helped offset lower volume, or perhaps there were some other factors bridging that gap between organic and net sales for grooming.
And the others?
Beauty was slightly under estimate, $3.73 billion versus $3.76 billion expected. Just a small miss, up 0.2% year over year. And healthcare was also a near miss, $2.72 billion versus $2.74 billion estimated, up 1.8% year over year.
Okay, so summing this all up, we've got overall beats on the headlines, decent organic growth overall, but with some surprising segment misses, solid net sales in key areas, but then this huge kind of weird surge in corporate net sales. How has the stock actually reacted to all this mixed news? Because shares of P&G over the past month have actually returned negative 1.4%.
Yes, and if you put that in context, that minus 1.4% for P&G stock looks quite different when you compare it to the broader market. The Zacks S&P 500 composite. That was up 3.6% over the same period.
So P&G lagged quite a bit.
It did. And right now, the stock carries a Zacks rank #3. That's basically a hold rating from Zacks' independent research. It suggests they expect it to perform roughly in line with the market going forward, not necessarily outperform or underperform dramatically. And this really brings us back full circle to why we do this kind of deep dive. Looking closely at these details, those segment organic misses, that corporate segment number, helps you understand why a stock might not just react to the headline beats. The market is often looking deeper at the quality and source of the growth across all the different business units.
It really is a different story once you get past page one, isn't it? We started with what looked like straightforward, positive news revenue up, EPS up, beats all around. But this dive hopefully has helped you listening unpack the real complexities in P&G's Q4. It reveals a much more intricate, but I think much more informative picture of how the business is actually doing.
Absolutely. The key question becomes, what do these specific segment results, the beats and the misses, in both organic and net sales truly tell you? What does it say about P&G's underlying operational health and maybe its strategic focus going forward? It really underscores that for these huge companies, you can't just paint with a broad brush. You need to understand those internal dynamics, and it just reinforces the value, I think, of digging into the detailed reports yourself, rather than just relying on those quick headlines.
A valuable lesson for sure.
So maybe here's something to think about as we wrap up. Considering this mixed performance across P&G's different divisions, some strong, some lagging, plus that curious corporate segment result, and considering the stock hasn't kept pace with the market recently, what might be the real underlying drivers causing these discrepancies? And perhaps more importantly, how might understanding that influence the way you evaluate other large diversified consumer companies in the future?